What if I told you the Federal Reserve is walking into the same trap that destroyed the 1970s economy? And this time, the consequences will be far worse. Right now, Jerome Powell faces an impossible choice. Cut rates and trigger inflation, keep rates high, and crash the economy. There's no third option. This isn't just monetary policy debate. This is the setup for the most dangerous economic scenario possible. Stagflation. High inflation combined with economic stagnation. It's the nightmare that central bankers fear most because their tools become useless. I've spent 3 decades studying central bank policy across continents. I've watched the Bank of Japan trap itself in deflation for 30 years. I've seen the European Central Bank struggle with negative rates. I've analyzed the Fed's mistakes during every major crisis since the 1980s. But what's happening now is different. The Fed has painted itself into a corner with no escape route. Let me walk you through the mathematics of this trap, because the numbers reveal a crisis that most economists are afraid to discuss publicly. The Federal Reserve has raised rates from 0.25% to 5.5% in under 2 years, the fastest tightening since Volcker's 1980s inflation war. But the economy never healed from 2008. Corporate debt hit $12.1 trillion. Consumer debt exceeds $17 trillion. Government debt approaches $34 trillion. The entire economy is addicted to cheap money, and the Fed just cut off supply. Now they're facing the consequences of their own policies. Inflation fell to 3.2% by late 2023, but shows resurging signs. Energy climbs, food stays elevated, housing continues its relentless rise, core PCE hasn't reached 2% target, but the economy is simultaneously weakening. GDP growth slowed to 1.4% in Q1 2024, manufacturing contracted 16 consecutive months, commercial real estate faces $1.2 trillion in maturing loans. This is the classic setup for stagflation, rising prices in a stagnating economy. The political pressure on Jerome Powell is becoming unbearable. President Trump has publicly demanded rate cuts, arguing the Fed is destroying American competitiveness. Congress is holding hearings questioning Fed independence. Wall Street banks are lobbying aggressively for monetary easing. Meanwhile, inflation hawks within the Fed are warning that cutting rates prematurely could trigger a 1970s-style inflation spiral that would ultimately require even higher rates to contain. Powell finds himself in exactly Burns' 1974 position. Burns, facing Nixon's pressure, cut rates too early during inflation, result a decade of chaos requiring Volcker's 20% rates to break inflation's back. But here's what makes today's situation more dangerous than the 1970s. The debt levels are astronomical. In 1974, federal debt was 34% of GDP. Today, 120%. Corporate debt was manageable then. Today, $4.6 trillion in corporate bonds mature over 5 years, issued when rates were near zero. Stay high. Corporate defaults inevitable. Fall, inflation resurges. The Fed has already begun signaling their intentions. Minutes from recent meetings show increasing concern about economic weakness. Several Fed governors have hinted at rate cuts beginning in late 2024. This is exactly what the bond market has been betting on. But bond markets have been wrong before, catastrophically wrong. Let me show you what stagflation actually looks like in practice, because most people have never experienced it. Imagine your grocery bill increasing by 8% annually, while your paycheck stays flat. Imagine gas prices climbing towards $6 per gallon, while unemployment rises to 7%. Imagine house prices continuing their rise even as the economy contracts, making homeownership impossible for an entire generation. This isn't theoretical. It happened in the 1970s, and the conditions are being recreated today. Stagflation, 1973 to 1982. Inflation peaked 14.8%, unemployment hit 10.8%. Multiple recessions. Dow went nowhere for a decade. Real wages declined despite harder work. But today's potential stagflation could be worse, because the structural problems are deeper and more interconnected than anything experienced in the 1970s. The 1970s economy was still primarily domestic with limited global integration. Today's economy is globalized, meaning inflation can be imported through supply chains, currency devaluation, and commodity price shocks that originate anywhere in the world. The 1970s saw rising productivity from early computerization and industrial automation. Today's productivity gains from AI and digitization remain mostly theoretical and concentrated in narrow sectors. Most importantly, the 1970s began with relatively low debt levels that allowed aggressive fiscal and monetary policy responses. Today's debt levels constrain every policy option and create systemic risks that didn't exist 50 years ago. Here's how the trap closes. If the Fed cuts rates to support the weakening economy, they risk triggering an inflation surge that could reach double digits. But if they maintain high rates, they guarantee a severe recession that could cascade into financial crisis. Commercial real estate alone could trigger systemic banking problems. Regional banks hold $2.7 trillion in commercial real estate loans, secured by office buildings that may never recover pre-pandemic values. Housing shows stress fractures. Mortgage originations fell 35% in 2023. Construction permits dropped to 2009 levels. Yet prices remain elevated because homeowners are locked into low-rate mortgages. Consumer spending is cracking. Credit card delinquency is rising, auto loan defaults increasing, student loan payments resumed, pressuring household budgets, corporate earnings decline as companies struggle with higher borrowing costs, zombie companies that survived on cheap debt are failing, bankruptcy filings increase across sectors. This is the environment in which the Fed must make its choice. Every time the Fed tried engineering soft landings during inflation, they failed. Greenspan created the dot-com bubble. Bernanke created the housing bubble. Soft landings are monetary mythology. With high debt and persistent inflation, central banks face binary choices: recession or inflation. No middle path. Fed economic models assume rational expectations and efficient markets. But markets aren't rational when the system is fundamentally unstable. We're witnessing the end game of 40 years of financialization. Since 1980, America restructured around debt-fueled consumption and asset appreciation. Real production was offshored. Financial engineering replaced industrial innovation. This model worked as long as interest rates trended downward and debt levels could continue expanding. But we've reached the mathematical limits of both trends. Interest rates cannot go significantly negative without destroying the banking system. Debt levels cannot rise indefinitely without triggering fiscal crisis. The Fed has run out of room to maneuver. Geopolitical pressures add inflationary forces. Energy security concerns drive up commodities. Supply chain diversification from China increases costs. Military spending expands globally. The dollar's status as global reserve currency, which has allowed America to export inflation for decades, is being challenged by alternative systems. Central bank digital currencies, BRICS payment mechanisms, and bilateral trade agreements are reducing global dollar demand. If dollar demand weakens, imported inflation becomes unavoidable regardless of Fed policy. This is why the stagflation scenario is not just possible but probable. The Fed cannot solve structural problems with monetary policy alone. They cannot print their way out of demographic decline, infrastructure decay, educational failure, or political dysfunction. Yet monetary policy remains their only tool, and that tool is becoming counterproductive. The tragedy is that this outcome was predictable and preventable. Decades of fiscal irresponsibility, regulatory capture, and short-term thinking have created vulnerabilities that cannot be addressed through interest rate adjustments. The coming stagnation will not be a temporary phenomenon that can be quickly resolved through aggressive central bank action. It will be a structural adjustment to an unsustainable economic model. Parallels to late Rome are striking. Rome debased currency to fund military expansion and consumption. Result: centuries of decline masked by temporary recoveries that left the empire weaker. America has debased its currency through quantitative easing. It has funded consumption through debt rather than production. It has prioritized financial engineering over industrial capacity. The outcome may be different in form, but the underlying dynamics are remarkably similar. The signs of imperial economic decline are unmistakable. Infrastructure decay, educational decline, political dysfunction, military overextension, and growing inequality. These are not problems that monetary policy can address, yet the Federal Reserve continues to operate as if interest rate adjustments can somehow solve structural economic problems that require fundamental reform. This is the central delusion of modern macroeconomics, that financial manipulation can substitute for real economic restructuring, that monetary policy can compensate for fiscal irresponsibility, and that central banks can indefinitely postpone the consequences of systemic economic imbalances. When stagflation arrives, and it will arrive, it will reveal that the Fed's power was always an illusion. Central banks can create money, but they cannot create value. They can manipulate prices, but they cannot escape economic reality. The interest rate trap is closing faster than most economists recognize. The Fed's next policy moves will be made under crisis conditions, with limited options and enormous pressure from all sides. When recession begins, corporate defaults surge, unemployment rises, markets crash, Fed faces demands to cut rates to zero and restart QE. But if inflation persists, these policies trigger currency crisis. Alternatively, if the Fed maintains restrictive policy during recession to protect the dollar's value, they risk a deflationary spiral that could be even more destructive than inflation. Japan offers preview. After 1990 bubble burst, 3 decades of deflation despite aggressive easing, zero rates, massive QE. Government debt exceeding 260% GDP, yet growth remained anemic. America cannot afford 3 decades of stagnation. Global hegemony depends on dynamism. Dollar's reserve status depends on confidence. Military commitments depend on fiscal capacity. Japan could manage prolonged stagnation because it had accumulated massive foreign assets during its boom years and faced no serious military threats. America has accumulated massive foreign liabilities and faces rising challenges from China and other powers. The stagflation scenario is thus more dangerous for America than the Japanese deflation model. Rising prices would erode living standards for the majority of Americans, while economic stagnation would undermine the country's global position. The social and political consequences could be severe. The 1970s stagflation contributed to political instability, urban decay, and social conflict. Today's America is more divided and more heavily armed than it was in the 1970s. Economic crisis in a society already experiencing significant political polarization could have unpredictable and dangerous consequences. History suggests that populations experiencing sustained economic decline often turn to authoritarian solutions and external scapegoats. The interest rate trap is not just an economic problem, it is a test of institutional stability and democratic governance. If the Fed cannot navigate this crisis successfully, the implications extend far beyond monetary policy. There is no escape route that avoids significant economic pain. The mathematics of debt, demographics, and monetary policy have created an impossible equation that cannot be solved without major economic disruption. The only question is whether that pain comes through recession, inflation, or both simultaneously in a devastating stagflationary spiral that could persist for years. Based on historical precedent, current economic conditions, and the political constraints facing policymakers, I believe we will experience both recession and inflation together. The stagflation bomb is already armed and ticking. The Fed's next policy moves will determine only the timing and intensity of the explosion that follows. The American economy is walking into the same trap that destroyed the economic stability of the 1970s, but this time the consequences will be far more severe and long-lasting. The Fed's impossible choice between recession and inflation has become America's impossible choice between economic collapse and social upheaval.